Okay, let's talk about cost of capital today. And the good news is that today's topic, much of it, we have already covered in a different fashion. If you remember, we talked about required return on stocks, um, return on bonds, which is the bonds yield to maturity, right? Those are returns to investors. But for the company that has issued those stocks and bonds, that can be viewed as being an expense of raising funds. And that's what we were talking about here. It's the cost of raising funds for those long term capital projects, which companies typically do with issuance of um, stock, which by definition is long term because it really doesn't have any maturity date, and bonds that are long term in nature. So, short term bonds, say a year or less in maturity. There's the debt that we may have um, on a current basis, right? Current liabilities, etc. Those will not be considered capital because that's money that's being used for operations of the company, and I'm talking about things like accounts payable, right? But rather longer term debt is considered capital. Of course, common stock, preferred stock is certainly considered capital. And we'll say that for a given company, there there is actually going a, specific a specific mix, a specified mix of debt and equity that may be value maximizing for that company. And we learn about that in a chapter on capital structure that we'll cover later. But given that there is a value maximizing mix of debt and equity, then we can figure out what the cost of capital for the firm is on an average. And now we're talking about weighted average. So we'll get to the concept of weighted average cost of capital, or WACC, for the company. But let's start with talking about debt itself. So here's a question. Says whiteboard industry plans to finance the move of traditional classroom whiteboards into cyberspace. Their outstanding bonds carry an 8% coupon. They will mature in 7 years and sell for $949.67. What is whiteboard's cost of debt? If the marginal tax rate is 30%, what is the whiteboard's after tax or component cost of debt, right? So if we were to calculate the yield to maturity on this bond, that is the before tax cost of debt for for the company. But the tax laws allows the company to deduct interest on debt as a tax deductible expense. So then the actual cost to the company is not really the yield, but rather it's reduced by its debt shield. So uh, the company is able to recover 30% of that cost because it can write off the debt against its taxes, which means that it only costs them 1 minus zero point 0.3 or 70% of the yield to maturity. But um, of course, first we have to remember how to get the yield to maturity on this bond, right? So we will go under uh, the normal assumptions that this is a semi-annual bond and it has, bond with semi-annual interest payments, and it's going to have $1,000 par value. So second FV. And then the bond's price was $949.67. So 949.67. Make it negative. If someone purchases the bond, it's negative cash flow, right? And then that's the present value. Once you buy the bond, you start receiving um, coupon payments. Coupon was 8%, but eight of what? Of $1,000 par, right? So let's put 1,000 right away as future value. Right? And coupon is of course, 8% of 1,000 is $80, but under our normal assumptions, this would be a semi-annual bond, so half of $80 is $40. That is the semi-annual payment, right? And the bond has 7 years to maturity, and that means that we've got 14 semi-annual periods. So 14 is N, and then compute I, and the answer we get is 4.49%. Remembering that this is a semi-annual rate, we multiply it with 2, to get 8.98%, right? And that is then the before tax cost of debt for the company. But of course, the company gets to enjoy a debt tax shield, right? So we are going to take this yield and multiply it with 1 minus the tax rate. So its tax rate being 30% or 0.3, and multiply this 8.98% with 0.7. 1 minus 0.3 would be 0.7. So we multiply this with 0.7, and we get 6.29%, and that is the after-tax cost of debt. We call it the component cost of debt because this is the cost of raising funds from one component, which is debt, right? Remember, there could be debt, there could be preferred stock, there could be common stock, various components. But this component cost of capital to the firm is 6.29%, which is the after-tax cost of debt. And you might notice that in notations, right? Notations, RD is the cost of debt, before tax cost of debt, and RDT is the after-tax cost of debt. All right. Now we're moving on to another thing that might make it different, the cost of debt different to the yield to maturity, which is the return on to the investor, is the fact that when the company issues bonds, it has to pay somebody a fee, and that would be an investment banker that can sell bonds the company to large masses of investors, right? And the fee that they charge is called flotation fees, the cost of floating debt. So Whiteboard can finance its new operations with 10-year debt issue, right? So, which means it's going to have to sell new debt, which will sell for par. So here's another thing to note: sell for par, which means that the selling price will be $1,000, our assumed par value being $1,000, and carries a 9% coupon. Right. Its investment banker, Bear Bulls, has agreed to float the debt for 2% fee. Right. So what is Whiteboard's cost of debt on an after-tax basis when its marginal tax rate is 30%? Right. So what happens if the company has to pay a fee for? Well, the fee comes off the top. So basically, we take the amount that the company will receive from selling debt and reduce it by the fee. So if it sells for par, then of course 2% fee is just going to be taken off of the $1,000, which will make it 2% less than $1,000. Anyways, so the new debt financing, of course, we're talking about flotation cost, right? Of course, the firm still gets to benefit from the tax exemption on its interest payments. So to get the after-tax cost of debt, the textbook presents us with this formula, which might look a little unwieldy, but it's rather straightforward. M is the maturity value or the par value of the bond, which is $1,000, right? We are talking about semi-annual interest payments, so we'll have present values of 2 times the number of years, 2 times the maturity, right? Because we're talking about semi-annual interest payments, and we'll have that many semi-annual payments. If the bond's issued for n years, then 2 times that many payments, right? This bond's going to be issued for 10 years, so it'll be 2 times 10. Then, of course, we're talking about semi-annual payments, so we'll calculate the 9% coupon on the $1,000 par and divide that by 2 to determine $45 as being semi-annual payments. Right? So far, nothing different than what we're used to. Here's the difference. Each coupon payment is the relevant interest payment on which the company gets a tax deduction. So we'll take the coupon and multiply it with 1 minus t of the tax rate to get the after-tax interest payments, right, that the company is making, or the company makes the interest payments, then recovers that much back in taxes. So it's the after-tax impact. And then whatever price the bond is sold for, this time it's the par value, 1,000, will be reduced by the flotation cost. And flotation cost given to us by in percent term, which is 2%. So we'll take 1 minus 0.02 or 0.98 times the price obtained from selling the bond, or 98%. Okay. And given all that, we're going to calculate the yield. We already have made an adjustment for taxes, so the yield we get will be semi-annual yield, right? And that's why we're talking about RDG by 2 in the denominator here. The yield we get is semi-annual yield. We'll just multiply it with 2 to get the annual yield. Okay, so that's what we are going to be doing, and we'll use our financial calculator so you don't have to get freaked out with this formula. Right? It looks unwieldy, so I wanted to put it up here and explain it to you. But for the selling price, we need to adjust it for the flotation cost, right? So $1,000 is the selling price. Bond is being issued at par. We multiply it with 1 minus 0.02 and we get $980. That's the price of the bond. Each coupon payment is reduced by its tax shelter. Coupon is 9% of 1,000. We divide that by 2 to get the semi-annual coupon and multiply it with 1 minus 0.3 or to get the benefits of the tax shelter incorporated in here. So 45 divided by 0.7 is going to give us 3150, and then we can go to the calculator to get the yield. So second FV, know that par value is 1,000, so 1,000 is future value. We could do all the calculations here. For instance, 9%, 0.09 of 1,000 is 90. Divide that by 2, we get 45. Right, that's the semi-annual coupon payment. Then we lower it by 1 minus t, or 1 minus 0.3. So multiply this with 0.7 and you get 3150. That's the payment. Right, 1,000 is the par value. That's also the selling price. Bond is selling for par, multiplied by 1 minus the flotation rate, which was 1 minus 0.02, right, or 0.98. That's 980. We need to make that negative, so we're going to input this as present value, right? Then there's 20 semi-annual payments. It's a 10-year bond, 20 semi-annual payments. 20 is N, and then we compute I. I get 3.288 or 29, but we multiply this with 2 to get 6.576 or 6.58%, and that is the after-tax cost of debt. When new debt has to be issued and we have flotation costs to be taken into consideration. Right? Typically, if you are going to raise new capital with debt, you will be using new debt issue, right? There's nothing else. With equity, we have internal equity in the form of retained earnings. The company keeps back some of the profits, not distributed as dividends to shareholders, but can keep some of the profits back as retained earnings. But that money belongs to shareholders, and it is equity. So sometimes you may have internal equity, and so with equity financing, you may not need to raise new funds all the time. But anytime there's debt financing used, we have to basically float new issues of debt. Okay, so let's move on to something very simple, cost of preferred stock. You might remember that preferred stock is the simplest to evaluate because there's a perpetual perpetuity model, or dividends are the same, they don't change, and so we can just use present value of perpetuity formula, right? Except, of course, preferred stock, we do have to worry about flotation costs. When company needs to raise funds with preferred stock, it has to issue new preferred stock, right? So Whiteboard's preferred stock pays $5 annual dividends and is currently selling for $50. Bear Bulls Incorporated agrees to float these shares for $1 per share. If Whiteboard decides to use preferred stock for its financing decision, what is Whiteboard's cost of preferred stock? Okay, so here, one thing we don't have to worry about is the dividend tax exemption, because there's no dividend tax exemption on, or there's no tax exemption on dividends. It's only on interest payments. So with any kind of stock equity financing, whether it's preferred stock or common stock, we don't have to worry about the tax exemption that accrues to the company. However, the cost of floating new equity will increase the cost of equity capital. Right? So here we have to float new stock. Preferred stock has fixed dividend payments, so constant perpetual dividend discount model will apply. Adjusting this valuation model for flotation cost, we can compute the cost of preferred stock. Basically, the only thing we know, well, if price is dividend over rate, then the rate is dividend over price. Only difference is the price will have to be reduced with flotation costs. If flotation costs are given to us in percent, we do 1 minus that percent flotation cost, multiply it with the price. If flotation costs are given to us in dollars per share, as it is right now here, then we just subtract the dollars. Right? It's at $1 per share is the flotation cost. So the cost of preferred stock is then the dividend divided by price reduced with the flotation cost. $5 divided by $49, right? 50 minus 1. And when you do that, you'll get 10.2%. That's the cost of preferred stock. Then let's look at cost of common stock. We have actually come across different methods of obtaining returns in common stock. There's, depending on if we can apply the constant dividend model or constant growth in dividends model, the constant growth model, or the capital assets pricing model can give us the return on equity based on the company's beta, right? And we can calculate, when we use those, we're looking at the cost of internal equity, which is retained earnings, right? And if we have to sell new shares of stock or raise funds with external equity, then flotation costs will also need to be considered, right? But what's the cost of internal equity? And here we have information that that can be used to get the company's required return on equity using the capital asset pricing model, right? The beta is given to us, risk-free rate, the market risk premium, right? So the market risk premium, which is the difference between market return and the risk-free rate, is already given to us as 8%. The beta is 1.5, risk-free rate is 3%. So the required return on this stock is 15%. 8 times 1.5 is 12, plus 3 is 15. We get 15%, right? Now, we have some other information provided to us. So Whiteboard's common stock sells for $25 a share. It is expected to pay $3.10 in dividends next year, and dividends expected to grow at 3% per year into the foreseeable future, computed cost of internal equity, right? So what we have here is a way to apply the constant growth model. If you remember, that constant growth model said P0 equals D1 over R minus G, and we have P0, we have D1, we have G, and we got to find out R, right? That would be cost of internal equity. Then we have some more information. If Whiteboard observes that the cost of equity typically carries a premium of 5.6% over cost of debt, and its before tax cost of debt is 9%, what's the cost of internal equity? And this is a rough method that can be used if the company's managers have enough experience and they know that there is a constant premium to the company's cost of equity over its cost of debt, and that hovers around a number like 5.6%, then you could simply add the 5.6% to the cost of debt, and we get the cost of internal equity. Right? So, with the constant growth model, where P0 equals D1 divided by R minus G, if we can reformulate that, a couple of steps in algebra will give us an expression for R. R is D1 by P0 plus G. So we have those numbers given to us. $3.10 is D1, 25 is P0, plus 0.03 will give us the cost of equity. And so if we get the 3.1 divided by 25, and that's 0.124 plus 0.03, and gives us 0.154, right? So we get 15.4% there. Then using the bond yield plus risk premium approach is another way. And of course, here you just add the risk premium to the bond yield. So 9 plus 5.6 gives us 14.6%. Okay, so what we have three estimates of the cost of internal equity for this company. So what's the best estimate? Well, best estimate is just the average of the three, right? Because that's the best way to get rid of errors, wash out the errors. And we may have been over-optimistic in some cases. Hopefully that gets washed away with under-enthusiasm for another case. Anyways, so the three estimates from the CAPM model, we had 15%. From the constant growth model, we had 15.4%. And then we had from the bond yield plus risk premium approach, we got 14.6%. So if we add the 3 and divide it by 3, we get the average, which is 15%. That's the best estimate. Okay, now what happens if we go to the markets to sell new shares of stock? Well, uh, flotation costs will need to be considered. So Bear Bulls will charge 5% to float new shares of Whiteboard common stock, right? Remember that Whiteboard's common stock sells for $25 a share, is expected to pay $3.10 in dividends next year, and dividends are expected to grow at 3% per year into the foreseeable future. What is Whiteboard's cost of external equity? Well, all we have to do is reduce this $25 a share by the 5% flotation cost, right? So it's D1 R equals D1 by P0 plus G, but P0 needs to be adjusted by the flotation cost, which is 5%. So 1 minus 0.05 will be 0.95. 25 times 0.95 is what we have in the denominator, right? So it's going to be 25 times 0.95 equals, and I'm just doing this not showing you the calculator not because there's special functions, but we can use some of the built-in functionality in here, right? So I just did, let me start over again. I started with the denominator, which is some more complex operation. So 25 times 0.95, that's 2375. Let's go in the denominator, right? But I don't have to save it and redo the calculation because there's a 1 over x button right here. So I can do 1 over x and get the reciprocal and then multiply that with 3.1, right, to get this value, and then add the 0.03 here and get 16.05%, right, 0.1605. So that's the cost of external equity for Whiteboard. Okay, so after we have determined, so far we have determined the following for Whiteboard. After-tax cost of new debt issue is 6.58%. The marginal tax rate is 30%. Cost of new preferred stock is 10.2%. Cost of internal equity, retained earnings, 15%. Cost of new common stock is 16.05%. And if Whiteboard's optimal capital structure is 40% debt, 10% preferred stock, and 50% common stock, and it has sufficient retained earnings, which means it's not going to have to raise common stock by selling new shares of stock, right? What is the weighted average cost of company? Now, if the company has used up all of its internal equity and has to raise funds by selling new shares of common stock, then what is its WACC, or weighted average cost of capital, right? So weighted average cost of capital is the proportion weighted average cost of firm's various sources of capital. Each firm has a value maximizing capital mix, which it strives to maintain over the long term. And we must use the after-tax cost of debt, since it is reflective of the true cost of debt financing. There's no difference between after-tax and before-tax cost of equity because dividend payments in equity is not tax deductible for companies paying those dividends. If Whiteboard does not need to use external equity, then its cost of capital is weighted debt times the cost of debt. Of course, before tax cost of debt times 1 minus tax rate is after tax cost of debt, right? Plus weight of preferred stock times cost of preferred stock plus weight of common stock times the cost of common stock, right? And well, the second expression simply collapses RD times 1 minus T into RDT. So if we already know the after-tax cost of debt, which we do in this particular case, then you can simply multiply that with the weight of debt, right? So 6.58% is the after-tax cost of debt. Multiply that with the proportion of debt. 40% is financed with debt. Then 10% with preferred stock, multiply it with the preferred stock, right? Cost of new preferred stock. This is the cost of new debt, right? Because in these two cases, there's no internal preferred stock or internal debt that can be used. Anytime we have to raise funds with debt financing, we must issue new debt. Anytime we have to raise funds with preferred stock, we must issue new preferred stock. And it's only with common stock that we can dip into some retained earnings. And so it's the cost of retained earnings or internal equity. And of course, multiply that cost with 50% proportion. Right? And so we carry out this calculation, and of course, you may make use of your storage function in the calculator. So 0.4 times 6.58 equals store 1, then 0.1 times 10.2, oops, I missed a number, 10.2, store 2, then 0.5 times 15, store 3. Anyways, we have that last number, just add, recall 1, the first number we stored, and then add recall 2. We get 11.15 to 11.15%. That's the weighted average cost of capital. When internal equity can be used, right? Once that retained earnings has been exhausted, then any additional common stock can only be obtained via an external issue. Then the firm's WACC jumps higher, right? And in notational terms, what's different is this: instead of R of S, which was cost of control equity, now we are using R of E, which is the cost of external equity, right? Which we also have from our calculations before. So once again, the only difference between these two calculations is this last number. Cost of internal equity here, cost of external equity here. And when we use that, we get the weighted average cost of capital, which is 11.68%. And understandably, it's higher because with external equity, we have to pay investment bankers a fee to float new equity. Okay, Whiteboard's competitor, Brown v. Board, just filed its 10K report. The report indicates that Brown v. Board has total debt of $20 million and total equity of $25 million. Right? And just in case you don't know, 10K reports are simply annual reports that the companies are required to file with the SEC. They have some quarterly reports called 10Q reports, and then annual reports called 10K reports. But it'll basically have the company's balance sheet, income statement, statement of cash flows, etc. Basically, that balance sheet is showing that Brown v. Board has total debt of $20 million and total equity of $25 million, with 1 million shares outstanding. The current capital structure of Brown v. Board is considered optimal. A quick glance at Brown v. Board stock quotes on Yahoo Finance reveals that the stock's been selling close to $30 per share. Company expects to pay a dividend of $3 next year, which is expected to grow at a rate of 5%. all Brown v. Board's outstanding debt is in the form of bank loans and carries a weighted average interest cost of 8%. Brown v. Board's marginal tax rate is 28%. What is its weighted average cost of capital, right? So a couple things we should take from here. The interest cost is 8%. That is on a before tax basis. We'll need to adjust that given the marginal tax rate, right? Then we can use the constant growth model equivalent, which was P0 equals D1 over R minus G, and we had used that and reformulated it to know that R equals D1 over P0 plus G, right? That'll give us the cost of equity. There's no preferred stock, just common stock and debt. And then what are the proportions? Well, basically, the current capital structure is considered optimal, allows us to use the current proportions of debt and equity. One thing we have to be careful of is that we should not just use the book values of 20 million in debt, 25 million in equity. And that if all of the debt is in the form of bank loan, then that 20 million in debt is actually its market value also, right? It's not bonds that are floating in the market whose price varies, right? It's just bank loan, and so the book value and market value is not going to be much different for debt, but for equity it will be, because book value of total equity is 25 million. But given that the stock is selling for $30 per share and there are 1 million shares outstanding, market value of equity is actually $30 times 1 million, or 30 million, right? And we must use market values in our calculations. So once we have the market values, we can simply use those proportions given by 20 million in debt and 30 million in equity. And anyway, so first, let's find the component cost of debt. There are two components, debt and equity. Before tax cost of debt is given as 8%. Obtain the cost of equity and use the constant growth model. We know that next dividend is $3, price per share is 30, and growth rate is 5%. So we'll get 15% is the cost of equity. This is the cost of internal equity. That's what we're talking about here. Okay, so to find the target proportion of debt and equity, first hint comes from the statement that the current capital structure is considered optimal, right? So proportions with the current capital structure is good enough. We can use that. And it's important to point that out here, because later on, when we study about capital structure, then we'll see what makes an optimal capital structure. But we'll have assume that companies are trying to maintain their optimal capital structure, right? And so if this is considered optimal, that's what we're going to use to find the company's weighted average cost of capital. 10K reports give us book values of debt and equity. Proportions based on book values should not be the target. Rather, target proportions should be based on market values. Since all companies' debt is in the form of bank loans, its market value is the same as book value, which is 20 million. Right? The market value of equity is 30 million, as we had observed earlier. So the target ratios on debt and equity is, well, the total capital is 20 million in debt and 30 million in equity, which is 50 million. So the target ratio for debt is 20 divided by 50, or 0.4, and the target ratio for equity is 30 divided by 50, or 0.6, right? So the weighted average cost of capital, we take the 8% cost of debt, multiply it with 1 minus the tax rate, because this is the before tax cost of debt, and then multiply that result with 0.4, that's the proportion of debt, right? For equity, cost of equity times the proportion of equity. Once again, we are talking about internal equity, retained earnings, but there's no adjustment for taxes necessary with equity. So we compute it out and we get the weighted average cost of capital for this company is 11.3%, right? Now, here's note that, the company may have different divisions which are engaged in different kinds of activities, which may carry different amount of risk. So both, it will be wrong to use one company-wide cost of capital to evaluate projects in the two different divisions, right? So we need to use appropriate cost of capital for each division. Brown-Wade board has two widely disparate divisions, Simply Board and Sky Board. While the corporate beta of Brown-Wade board is 1.2, you have determined that the divisional beta for Simply Board is 0.8, while that for Sky Board is 1.5. Knowing that Brown-Wade board has a cost of equity of 15% and the risk-free return is 3%, compute the divisional cost of equity capital for both Simply Board and Sky Board. Right. Assuming that each division has the same cost of debt and targets a similar optimal capital structure as the firm, calculate each division's WACC, right? So, the cost of debt, which was 8% for Brown-Wade board earlier, is the same for the two divisions, Simply Board and Sky Board, right? It's only the cost of equity that's going to be different because different betas, right, for the two divisions. So, well, first, let's use the company-wide cost of capital. Given the risk-free rate and the beta of the company, we can find out what the risk premium is, right? So this is the SML equation. It's that company's required return, in this case the cost of equity, equals the risk-free rate plus the market return minus the risk-free rate, which we call the risk premium for market, or the market risk premium, times the company's beta, right? So what we know is the company's cost of equity, we know the risk-free rate, we know the beta, then what's the risk premium? Market risk premium is then the company's return minus the risk-free rate divided by its beta, which is 15% minus 3% by 1.2. That's the company-wide beta. And we find out that the market risk premium is 10%. Then, given that the two divisions have different betas, we can find out their cost of equity, cost of internal equity for Simply Board is the risk-free rate plus market risk premium of 10% times its beta of 0.8, which is 11%, and cost of internal equity for Sky Board is 3% plus 10 times 1.5, 1.5 being its beta. So it's just the betas that are different for the two divisions, right? And we get 18%. Now we are ready to obtain the divisional cost of capital. We just got the cost of equity for each, right? But the cost of debt's the same for both, and the proportion debt and equity is the same. So we basically find out using the 8% before tax cost of debt and 28% applicable tax rate. 40% is the weighted debt, 60% is weight of equity, and that proportion of the cost of equity is different for these two divisions. That's the only difference. Instead of 11% here for Simplyboard, use 18% for Skyboard, and we get the respective weighted average cost of capital, which is 8.9% for Simplyboard and 13.1% for Skyboard. Right? And with that, we end this show. I'll be back with more later.